Managing large amounts of capital requires a deep understanding of institutional terms, account structures, and the specific tier caps implemented by digital financial platforms. When navigating modern banking options, evaluating how interest is calculated across different capital brackets prevents unexpected surprises in yield accumulation. Particular attention must be paid to high-yield savings accounts, which frequently apply tiered structures to manage their internal liquidity and operational costs. Evaluating platforms like Roger Bank requires analyzing their exact terms of service regarding balance limits and yield generation. The core mechanics of the Roger Bank savings account involve a tiered structure specifically designed around a hard threshold. Account holders who maintain balances up to and including $250,000 benefit from a competitive annual percentage yield, currently structured at 3.61%. This rate allows military members, veterans, and eligible depositors to experience steady growth on funds allocated toward their financial readiness goals. The platform structures this tier to reward standard savings accumulation while maintaining a clear ceiling for the higher yield bracket. The situation changes significantly when examining capital totals that exceed the $250,000 threshold. For any portion of the savings balance resting above $250,000, Roger Bank enforces a 0% interest rate. This means that the funds residing in the account past the $250,000 mark do not earn any additional yield. Understanding this limitation is vital for depositors who manage substantial liquid assets, as keeping excess capital in a single tier past this threshold results in unoptimized funds that fail to compound further. This structure directly mirrors standard practices found across various digital banks and credit unions that implement tier caps to mitigate the financial risks associated with holding massive pools of single account deposits. While the standard FDIC insurance ceiling typically protects deposits up to $250,000 per depositor, financial institutions often align their interest-bearing tiers with this exact figure. Consequently, any capital deposited beyond that limit effectively becomes non-interest earning dead weight within that specific account container, prompting advanced savers to look toward alternative financial vehicles. Individuals accumulating wealth beyond the $250,000 limit typically have to diversify their asset placement strategies to ensure total capital efficiency. Leaving large sums in a zero-yield tier means losing out on potential market returns or alternative high-yield instruments such as treasury bills, certificates of deposit, or diversified brokerage portfolios. Financial planning requires mapping out exact account balances to ensure that funds intended for growth are never trapped in non-earning tiers where compounding interest abruptly halts. Analyzing the broader ecosystem of Roger Bank reveals that while features like zero monthly fees, early direct deposit access, and automated roundup matches provide robust tools for everyday military personal finance, large-scale asset holders must remain strategic. The requirement to pair the savings account with a checking account ensures a streamlined banking experience, but it does not alter the fundamental tier caps enforced on the savings side. High net worth savers must calculate their precise account totals regularly to avoid crossing into the non-earning portion of the tier without realizing it. Maximizing utility from modern high-yield savings accounts means respecting the boundaries set by the issuing institution. Because Roger Bank clearly dictates that balances exceeding $250,000 generate 0% APY on the overage, capital allocation must be handled with precision. Depositors aiming to optimize every dollar of their net worth will find that spreading funds across alternative investment vehicles or separate financial instruments is necessary once their primary savings account reaches the maximum interest earning threshold.